Hello, and welcome to this tutorial on FX Forwards Part 1. In this tutorial, we'll look at how you can use FX Forwards to hedge FX risk on other transactions and how the FX risk in an FX Forward itself can be hedged. Let's start with some definitions. An FX Forward is an agreement to exchange one currency for another at an agreed rate, the forward rate, with settlement on a future date. For actively traded currency pairs, such as Euro-USD, the forward rates may be quoted out to 10 years, though most liquid will be the rates for less than 1 year. And the slope of the curve will depend on the interest rate differentials between the two currencies. So as we see here, there are different forward rates for different currencies, and this curve can be upward sloping, it could be flat, or it could be downward sloping depending on interest rate differentials. And we'll talk about that more later in this tutorial. So who needs FX forwards? Well, it can be used in a lot of different ways. For example, a business with a payable or receivable due in foreign currency. They may have purchased something in a foreign currency, or they may have sold something in a foreign currency and the payment hasn't occurred yet and they want to hedge that exposure. Or they may have sales or inputs denominated in a foreign currency and they want to hedge that. Or they could be a borrower in foreign currency. And this could be a business, bank, agency, or government. And they want to hedge the value of those future debt payments, not to be exposed to changing exchange rates. They could be on the other side of that trade. They could be an investor in foreign currency assets, for example, buying a bond, and they want to hedge their returns or some of the cash flows on that bond against changing FX rates. And they could be a financial institution with assets and liabilities in several currencies. And FX forwards could be used as a way of controlling the net exposure of their capital to FX risk. So let's look at an illustration. Suppose we have a US business and they've purchased some equipment from a French supplier for 50,000 euros. They don't have to pay for it today. The payment is due in 1 year when the equipment is expected to be delivered. Now, currently the Euro-US dollar spot rate is 1.2. So that would indicate roughly their price for this equipment would be $60,000. That is, if the exchange rate doesn't change. But in fact, the dollar cost of the equipment, when they pay for it in a year, will depend on the FX rate in 1 year. And as we see in this table or this chart to the right, the cost of the equipment could vary a lot. So if it stays at 120, they will pay the 60,000. If the euro becomes weaker and they can buy euros for at 1-to-1 instead of 1.2-to-1, it'll cost $50,000 the equipment. Or going in the other direction, if the euro becomes much stronger and they have to pay $1.4 for a euro, they'd end up paying $70,000 for that equipment. So they may want to hedge that exposure. So they go to their bank and let's say they buy $50,000, 50,000 euros forward from the bank, and the bank gives them a rate, Euro-USD rate of 1.22. So that's the rate that the business will pay in a year, but it's fixed today, so they don't have any exposure. So that means the euros needed to pay for this equipment will cost 61,000 because they'll be able to buy the euros they need in 1 year from the bank at 1.22, regardless of what the actual exchange rate is. So regardless of what this rate is in 1 year, the cost to the company will be $61,000. The bank essentially has assumed that FX risk by issuing the forward to them. And the bank may or may not hedge that exposure. So let's look at what happens if they don't hedge. So if they don't hedge, they essentially are picking up the gains or the losses that the company would have had. So if the dollar strengthens, the euro weakens, and the bank can buy the 50,000 euros for $50,000 1-to-1, they'll have a large gain. And if the euro strengthens, they'll have a loss. And how much of the gain or loss, of course, will depend on this range, and there's no guarantee that it couldn't go outside of this range. So let's consider, what happens if the bank doesn't hedge. So they've done this forward with their client. So they have an outflow of 50,000 euros to their client in 1 year, and they are expecting an inflow of $61,000. No exchange of cash today in either currency. And then let's say the euro-US dollar is 1-to-1. So the euro's weakened from its current spot rate, and they can go in the market at that point and buy the 50,000 euros that they need to deliver to their client for $50,000. And so they'll end up $11,000 ahead. So great for them. But it could go the other way. Let's say the euro dollar is 1.4 in a year. And so they're going to go in the market and they're going to pay $1.4 per euro, or a total of $70,000 in order to get the 50,000 euros they need to deliver to their client. And that's going to leave them with a loss of $9,000. So what if they want to hedge? Well, of course, they could hedge by doing an offsetting FX forward with another client or perhaps another bank. But can they hedge without doing an offsetting FX forward? Well, indeed they can, as we'll show now. Suppose the bank can borrow for 1 year in US dollars at 2% and invest for 1 year in euro at 1%. The bank needs to execute 3 transactions today that will leave it in 1 year with the 50,000 euros that it needs to pay the client. They want the total cost to be less than or equal to $61,000 because that's what they're getting from the client. And they don't want to have any exposure to the euro-US dollar spot rate at that time. That's what it means to be hedged. So what do they need to do? All right, well, let's start with what they need. They need to pay out 50,000 euros in 1 year. So they could borrow, or rather they could invest some amount of euros today such that they will have 50,000 euros in 1 year. And the amount of euros they would need to invest today would be this, 49,505. So 49,505 invested at 1% will grow to 50,000 euros in 1 year, and then they can pay their client. So where do they get 49,505? Well, they could purchase that in the spot market today, and using today's spot rate of 1.2, they would pay $59,406 for that 49,505 euros. So now they've covered that. But where do they get the $59,406? Well, they could borrow it. So borrowing would mean they would receive an inflow of $59,406, and we assume they could borrow at 2%. So they're going to pay 2% on that $59,406, which means principal plus interest due in 1 year will be $60,594, which is less than the $61,000 they're receiving from the client. So when you net all the flows together, they have nothing today. They're exactly flat for euros 1 year, and they end up $406 to the positive in dollars. So they've made a $406 profit locked in. And so note they have the 50,000 euros for their client. The cost of that is less than the 61,000, and they don't need to go into the market to buy euros because they've already got the euros. So it satisfies all 3 conditions. Now, what if the US dollar interest rate were 3% and not 2%? So they still need to borrow this 59,406, but they're going to pay 3% instead of 2% for it. And so that means they're going to actually owe a slightly larger amount, 59,405 times 1.03, and that's going to be 61,188. So that's more than the 61,000 they are due to receive from the client. So they're going to end up a little bit short. Now, what the bank has done with these transactions, these 3 transactions, is they've effectively replicated a forward purchase of euro-US dollar synthetically that they need to hedge the forward sale of euro-US dollar to their client. So let's look at this in reverse. So they're getting 61,000 from the client, and they need to pay 60,594 on their loan. That 65.94 that they pay on their loan at 2% would have allowed them to borrow 59,406. So they've borrowed 59,406 at 2%. They've taken that 59,406 that they've borrowed, and they have exchanged it into euros. The 59,406 exchanged for euros gives them 49,505, and then they invest that at 1%, and they will end up with precisely what they need in 1 year, 50,000 euros. So note what we've got here. We've got basically an outflow of 65.94, and an inflow of 50,000. So that offsets what they've got on the FX forward trade with their client. So effectively, they owe this amount, 65.94. They're owed 50,000 euros here on their investment. And this is what they owe on their borrowing. And that replicates a forward purchase of euros for USD. So effectively, they have purchased 50,000 euros synthetically at a cost of $60,594. And so that implies an exchange rate of 1.2119. And since that 1.2119 is less than the 1.22 that they offered their client, they've locked in a profit. Now, the second case where we assume the borrowing was at 3%, we see in that case, they end up owing 61,188 instead of the 65.94. So the 61,188 that they owe is to buy 50,000 euros, and that implies a forward rate of 1.2238, which is more than the rate they gave to the client. So effectively, they sold euros to their client at 1.22, and then they've synthetically bought those euros using these three transactions at a higher price, 1.2238. So clearly, they would have mispriced the forward rate they offered to their client. Now we can look at how this varies across US dollar interest rates holding the other variables constant. So we considered these two cases where the US dollar 1-year rate was 2% or 3%, and we got these two exchange rates. Let's look at this case where it's 1%. So if it's 1%, which is actually the same as the euro interest rate, this 59,406 is going to end up being worth $60,000. So effectively, they are paying $60,000 for the 50,000 euros, or 1.200. So the forward rate, the replicated forward rate, would be identical to the spot rate, and that's because the interest rates are identical. The US dollar 1-year interest rate is the same as the 1.1% euro 1-year interest rate, and because of that, the spot rate is the same as the replicated forward rate. And if we look at the other direction, let's say US dollar interest rates were less than 1%, let's just consider 0%. So if it were 0%, their 59,406 borrowing is going to cost them, nothing. They'll just pay the principal back. So effectively, they're buying their 50,000 euros for 59,406, which implies this exchange rate, which is less than the current spot rate. So we see here it's less, here it's the same, and then here it's higher. Okay, and we can also look at this by directly relating the interest rate differential between dollars and euros. So it could be the same. The dollar rate could be higher. The dollar rate could be less. And then we could look at the forward rate, the premium or discount in pips. So minus 119. Remember, a pip is this fourth decimal place here. So we can maybe easiest to see this one. This is 119 pips over 120, 1.20. This is 0, and then this is going the other direction, minus 119 pips, and then here it's plus 238 pips. And so frequently you might see the quotes expressed just as this difference based on the interest rate differential and a difference to the spot rate. So let's wrap up with some conclusions. So FX forward contracts are very useful to hedge FX risks, as we've just seen. FX forwards can be replicated by borrowing and investing in the two currencies. FX forward rates are a function of both the FX spot rate and the interest rate differential between the two currencies. Quotes may be in terms of a premium or a discount. They may be expressed in those terms in pips to the FX spot rate. And if the base currency in a currency pair has a lower interest rate than the quote currency, the FX forward curve will be upward sloping, a premium in pips, and vice versa. So that's it for this tutorial on FX forwards. Thank you for listening.